Welcome to Real Men of Real Estate. I'm your host, Steve Matley, president of Coast to Coast Equities, Inc. Today, we're going to answer that question. Where's the money? Where do we get the funding for real estate projects, real estate investments, development projects? Well, with our two experts today, we're going to discuss this and find out some answers. So, our other Real Men of Real Estate with us today, Tunde Ogunwole. He is with Commercial Development Manager with Trammell Crow. Welcome, Tunde.
It's good to be here.
And on the other side, we have Brian Fox. He is the owner and broker at Fox Real Estate Group out of Orange County. Welcome, Brian.
Thank you, appreciate it.
So today, guys, we're talking about where do we get the money for these projects? So we work in different things. Brian, mostly you're doing kind of residential real estate. Tunde, you're doing commercial development projects. I do land flips and land development projects, and all of them require the same thing, money. They've got to be funded from somewhere. So let's talk about the two basic forms of funding. I'm going to start with you, Tunde, over here. Debt versus equity. Define those for us.
Well, obviously, debt is some instrument that has a obligation that needs to be repaid, and equity is an investment with the hope of an upside or a return. So those are the two ways that we tend to define debt versus equity in the commercial and the industrial space.
Okay, and the important thing about debt versus equity is debt is money you owe back no matter how the project goes. Equity is usually at risk.
That's right.
And they become kind of part owners with you. Right. Brian, in your side of the world, you're doing more of the residential home resales. Do you use both debt and equity in funding those projects?
Yeah, so we do primarily resale. We also do flip, but the majority of what I do is consulting, giving my opinion, obviously. We're doing it here. I do it on a daily basis. The biggest thing is making sure that people stay in the boundaries of whatever project they're trying to complete. And we do both. So every decision is made based upon how the calculation will look between debt or equity. So can I bring in a partner and make this deal work? That's always the ideal way to go if you have a good partnership, because you don't have to deal with going through the bureaucracy of the bank. You already have the bank and you just partner with the bank and you become a partnership and you move forward. The debt side of it is, do I go through a loan and pay the points and everything else I would need to do? And typically those projects move kind of fast. If it's a resale deal, 30 to 45 days on your financing, and it's normally just through Freddie Mac, Fannie Mae, very easy deal. But if it's something that's more of an investment related thing and you need to do a flip or turn it over, the ideal way would be to find someone who wants to partner with you on some scale. We have a deal right now that we're doing that someone's putting in all the cash and we're giving him a return for his money. So it's an equity partner, but he's serving as debt, if that makes sense.
Okay.
Yeah, so that's the best way to do it for us. Okay.
So there are some pluses and minuses for both. And to really break it down simple for the folks at home, most people have purchased a home and or at least purchased an automobile. And that down payment, that's the equity. And what you got from the bank was the debt, and they work together to get what we want. There's pros and cons. Now, Tunde, what is the upside to using debt versus equity in your projects?
Well, the projects that I typically work on are big box industrial. We're here in Southern California, and a lot of the projects that I work on are Class A industrial or logistics centers, e-commerce buildings. Typically, the benefit is to have a mix of both. Most of the capitalization is about a 55-60% equity investment, and then you have the balance of it in the loan. And so there seems to be a preference for a conservative ratio. The conservative shows that there's a significant commitment on the equity side. In the example that you use, the money that's coming out of your pocket, instead of it being $2,000 in a $10,000 car, it's $5,000, $6,000 in a $10,000 car, and then you get the loan for the rest. But for our product type, you see a lot of that type of capital structure, and things seem to be going really well. It's institutional capital for the most part, big banks, and then large capital.
So why can't we just use equity for all of it?
It can be done. I think the preference typically when you go into construction risk, and the projects that I tend to work on are anywhere between on a short end, a 3-year project to 5 or 6 year project. When you go through the construction process, typically what's most often seen is a debt on that side, just to manage the construction risk, and then there's a takeout loan usually on the back end, and we can talk about that too.
Okay.
If you'd like.
Brian, when you do your projects, as you mentioned, sometimes people come in and they are equity partners, sometimes there's loans. The return that you owe on both of those, you're going to owe an equity partner a different amount than you would owe the bank as interest on a loan. So talk to us about that.
Okay, so traditional money, that's the money we all hear about. I said Fannie Mae, Freddie Mac, but those are the two major bodies that fund most of the regular collateral. They're the people who will give institutional cash, who put less down payment. But the problem there is if you're trying to if we're talking two worlds, one is just buying a house for myself, like this is my house. Institutional money is just fine because those timelines are set based on 30 and 45 days. No one's going to have a problem with closing in that long of a time frame. But if you're actually trying to do an investment that you're trying to get a return on in a short amount of time, today we call it flipping, but whatever it is, if you try to find a property that is of good, that has embedded equity, has equity that if you fix the property up, there would be more of it, then those deals will have to, the timelines are very short because there's a lot of money out on the street right now that's wanting to scoop up good deals. If there's good returns in real estate, there's TV shows about them, for goodness sakes, they're everywhere. So if you want to get that kind of a deal done, you have to be able to shrink the timeline. If you're going to shrink the timeline, that means you're using either non-institutional money that asks 4 questions, and if you pass the 4 questions, they'll give you the money within 7 days, 10 days. We typically call that hard money, but it can be called other things. But the non-traditional cash will typically be anywhere from low-end 10%, high-end 15%, 2 points to 4 points. That meaning, so it's very expensive money. The object
Compared
there,
to a bank who's going to charge you what?
Correct. The bank will can charge you no points, and the interest rate is, let's say, 4.25%, 4% for regular money.
So it's 2 to 3 times as expensive to use the hard money.
2 to 3 times expensive on the interest rate alone, plus the points would probably, I mean, you're talking probably maybe 5 times expensive, 6 times expensive. So it's way more expensive. But the object there is that you're finding, if you would only do that if you found a really good deal that made it worthwhile to do so. The better option than both of those is to find a human being who is cash rich, project poor, right? They're looking for opportunities right now in the world we are in, especially with all the flip shows going on, and everyone is doing a flip of some kind. Everyone's a realtor, everyone's doing a flip, everyone's involved in this stuff, which means projects are hard to find. And if it's a good project, if it's a project that'll work, returns are hard to find. And so in that, it's good to find someone who's cash rich, who trusts you to be able to do your job and find a deal and put it together, and you would use their money and give them a dividend. So our investors will typically make on average around 10% on their money, but we get them back to them in 4 to 6 months max, and it's back to them. We don't really they don't ask us a lot of questions because we scrub the deal first.
Okay, and so that's normally known as private lending.
Private lending.
Now, Tunde, do you use those in your projects, private lenders?
In the projects that I work on, we don't really have a big market for private lenders. What's really interesting about what Brian talked about is, I'd say, multifamily and industrial specifically as product types are in favor. So you often see people who are cash rich and project poor who are really looking for those types of deals. The cycle in terms of how long it takes to do a ground up development project is a lot longer than the turnaround that you're talking about. We're looking at a 3 to 4 year 3 to 4 year duration, but it's more institutional capital. On the debt side, you tend to see LIBOR, London Interbank Offer Rate, plus 150, 175 basis points. That typically tends to be what we see on the construction loan side, and on the equity side, you see double-digit return on equity.
And that's what I get to is probably the private equity is probably more important than what you're doing.
Right,
as opposed to the private debt.
Exactly. You don't see the private debt as much.
Okay, and so how does that work using individuals for the equity?
So there's a couple different ways that you could see the capital stack. We can have high net worth individuals who and I think you often see it in some of your deals with the syndication, where you have people who are high net worth individuals who are willing to contribute their hard-earned money as the equity. But more regularly, you have shops, whether they're institutional equity shops or REITs. They'll put in equity, hedge funds, REITs that'll invest on the equity side, or just find joint venture capital partners, whether they're institutional pension funds, et cetera, who are willing to place capital in ground-up industrial.
Okay, and so you mentioned syndication. So real quick, syndication, if you don't know what it is we take a project. Syndication is a pool of various people coming together, putting their money together, and we essentially sell shares. As if it's a company, we sell shares of the project to different people who come in as equity partners. Right. Okay, so we've talked a little bit about different types of debt and different types of equity funding. If I want to be a private lender, how do I get involved in this?
Yeah, that's a good question. So I can't speak to what you guys do. My guess is you have a list of accredited people and you kind of reach out to them on a list. Is that right?
Well, it's previous relationships have already been established for the most part. So that's who we typically.
So on our side, what we would do is it's very easy. It's kind of word of mouth, and we get involved in these people. And if I do a deal for someone, that, hey, if you find anything else, let me know, and it kind of spirals from there.
Okay, we're going to have to take a short break. When we come back, we're going to get deeper into this and talk about how do you qualify for debt and for equity. I'm Steve Matley, your host for Real Men of Real Estate. We're going to be right back after this.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
Welcome back to Real Men in Real Estate. I'm your host, Steve Matley. Today, we are discussing where's the money? How do we find funding for real estate projects, development projects, real estate investments? Brian Fox, Tunde Ogunwole are joining me today, and we've been discussing debt versus equity and different types. And what I want to get into, guys, on this one is how do you qualify for a bank loan? So this time I'm going to talk with you, Brian. I'll start with you over here. What do you have to do to go get this loan from the bank?
So if it's standardized money, so let's pretend the money everyone can get, a school teacher, firefighter, policeman, basically the general everybody who's a W-2 person can go into the bank, and with whatever minimum down payment required is for that particular project they're getting, they apply for the loan. That loan will require asset documentation, income documentation, social security information, just basic pedigree information. And once they've gotten through this short process of a couple weeks, they'll be technically approved for the loan and they can take down the project. And that's on regular money. Do you want to go into the other projects now?
Yeah, so sometimes we're getting deeper stuff. Now, Tunde, you do some more complicated projects.
Sure.
Yeah, so it's a little more than slap your W-2 on the table and let's get a couple of employer references, right? Because you're talking big money for big projects, much higher risk. How do we qualify for that kind of money?
It's a different world, I would say, than what's described earlier. I'm going to make an example of an high-end industrial project in a Class A location. It's Maine and Maine in the middle of the Inland Empire. If it's a $100 million project, and again, these are large projects, and we're looking at a capitalization of $40 million construction loan, and the equity is the $60 million or so. To qualify for the construction loan, you've got pretty much a 3-page checklist plus that you got to go through. You have to define all the estimates that you got in terms of the cost of construction, have the cost for all the consultants who are associated, permits and fees need to be verified, and then the credit worthiness of the underwriting. So whether it's the developer and their joint venture partner, that has to be described in exhaustive detail in terms of the capitalization that they're looking for, what type of equity, what their past performances look like. So it's a pretty rigorous process.
It's a full business plan.
It is a full business plan. In our organization, we go through this investment committee approval on the front end on the equity, and a lot of the data that we pull together is presented for the construction loan. So it's a process.
Brian, on your end, those loans have to be secured. Right. So what usually securing means that the bank has some guarantee of getting paid back if everything goes down south, right?
Right.
So what do we use to secure those loans?
Well, so you use the property. Actually, I want to say real quick, it's funny, that same qualifying, that's what someone would have to do in our world if they were self-employed. They got to do all that same stuff for a minimal amount.
The stated income deal's dead.
Yeah, that is, I mean, there's single bank statement programs you can do those, but the reality is if it's not like super vanilla butter, like it's going to require all that documentation. But as far as what they secure, so in that world, they secure it with the real estate property. They don't do securing of all of the other assets. They simply supply the person that they have income, and the idea is the safety is the fact that this person has long-term employment. Will it continue? More than likely, yes. So we'll give them the loan based upon the equity in the property, and if there's any problem, we'll take the property.
And generally between the property and maybe that person's income for the next year, that would cover the loan basis pretty much.
Yeah, they would just look at that as a general and say, okay, the pedigree of this person is they have long-term employment, they've got this particular income. Would the income change? No, the income would change. The only thing that would happen is if he got fired, and then he would have unemployment, that would stabilize us, and then he also has the equity. If we don't get our payment back, we go through the foreclosure process and we take the property, refund ourselves, and sell it on the open market.
Right, okay, and Tunde, on the commercial end, there's a little more at stake.
There's a little bit more at stake because, again, on ground-up development, while you have the land, you may not have the improvements that will make the balance of the construction loan. So the guarantee process is somewhat similar, whether or not it's an institution. One of the partners has to decide what type of guarantee is going to be provided in addition to the real estate through the construction process. So
and so the big problem is on the one side we already have an improved piece of land, and so we know that the property's pretty much worth what we're, much less than what we're borrowing. On this side, we have a project that's worth $500 million, but the land may only be worth $10 million.
Exactly.
Because we haven't built it
We
yet.
haven't built it yet. We have to provide
It's just dirt.
Exactly.
And so now we're borrowing to get something far in excess of what the land value is. So
That's right.
other assets have to come up to secure that.
Exactly.
And that can mean, this is where developers really take a risk. They have personal guarantees. Their house, their car, grandma's china, the kids' college fund, their retirement, all goes up on the block. And you kind of spin the roulette wheel and hope this thing comes out. And that's why when we have a crash, a lot of developers end up out.
It's helpful to have the viewing audience fully understand that, because developers have their reputations vary in terms of how communities perceive the developer, and knowing how much is at risk and how long you're at risk, the level of risk that the developer is facing and how long it takes to go through the development process can be significant and difficult.
So when you're thinking about developers and thinking, oh, these are the rich developers make a lot of money, understand they are willing to do what the vast majority of people are not willing to do.
Put all of their
Put
money,
their
all
whole
of their
life up.
assets, put their whole life up, their business and others' businesses, potentially, depending on how the partnership is structured, on this one project.
And it's very entrepreneurial. People who start businesses do the same thing. They stake everything on there, and if it fails, they're back to zero.
I mean, then wouldn't it make more sense to bring in partnerships that are really more equity?
And that's part of that, and that's part of the, when we talked about that stack,
Yeah.
that 40 million on the construction loan and the 60 million on the equity side, having a group of partners or having a strong relationship is something that's often part of the ingredients to diversify the risk on the equity side.
And
Absolutely.
And it reduces the risk from the lenders, and that's why on your end it's 20% down and 80% borrowed, and over here it's 60% down and 40% borrowed. That's why that mix looks like that.
kidding.
Okay, so let's talk about some non-traditional funding sources. So you talked about hard money loans. This is where we don't go to a bank, we just go to somebody who's got a load of money, and you answered questions.
Right.
What kind of questions are we answering?
They're interested in really a couple things. So there's term, a lot of people may understand this, ARV. They talk about after renovation value. So basically what we're saying is that if I'm taking a project, I want to know that, and there's a lot of banks offering 100% of today's value because they're basing it on what you're going to do when you fix it. So if you bought a house for, let's say, $100,000 and it will be worth $200,000, well, then yeah, I'll give you the 100 because you're going to double the equity in the property when you're done with the renovations. So they'll ask you basically value-based questions. They want to make sure that you have the ability to repay this loan. So they're not going to take it necessarily off the equity of the property. They want to make sure that you have some small amount to pay for it. But if not, they'll just take the project and your credit worthiness. So they'll ask a couple basic questions. Is the house standing? Is it there, first of all? Which actually is a question you don't think they'd ask, but is the house there? Is it in good shape? Are we going to fix it? Do we have a plan for it? What's the budget? And do you have the ability to pay us if there's a problem? Not to the degree that Fannie Mae and Freddie Mac will, but they still want to know that this guy is about to be able to cut a check if necessary to do so. They don't just lend that money to anybody arbitrarily because they're a bank too.
Okay. So other non-traditional funding sources, there's people that we have, the private lenders that aren't just hard money, they invest through their retirement accounts.
Yeah.
You can have a self-directed IRA. Now, I don't know, Tunde, do you have any experience kind of working with these kind of people?
I have a couple.
They don't usually go into commercial projects.
Yeah,
either.
I have a bunch of friends who are setting up projects and have done projects more on multifamily residential or single-family
That's
residential.
right.
That's where I typically see self-directed IRAs.
And there's self-directed IRAs, self-directed health savings accounts.
Exactly.
And what those are is you can take an old 401k from a previous employer, you can take any IRA, convert it to self-directed. Now you pay a fee, you better have some money in there and be ready to invest. You don't want to start it as that. And then you can actually, through your retirement account, invest in real estate or a lot of other different things to grow that. And then there's 1031 exchanges. You worked with those, Brian, I believe, right?
And yeah, actually, to go back on the self-directed IRAs, there are some things you can do really neat. So there's also what you can do with a life insurance account. So life insurance account, let's say you have that funded to $200,000 and $300,000. You have the ability to take a loan from yourself. You're not going to pay a penalty on it. You actually will take a loan from yourself, and the set interest rate, you can set the interest rate above anything above 1%.
Right.
So what you could do is you could borrow your own money, pay yourself back an income on top of that money. So you are acting as your own bank, partnering with your savings account.
That's right.
And you could borrow the money, use that for the renovation, and pay it back, but also receive a dividend on top of your own.
And grow the value of that policy.
You can do that. Yeah, there's some things that you can do like that. People may not even realize they have this because most people are used to the 401k and people getting advice like, well, you've got to deplete it and that's going to cost taxes.
Right.
And so that's very common advice, but you can actually borrow off other things and pay yourself back as long as you're comfortable. But as far as 1031s, yes. We're actually doing a couple right now. So 1031s are very simple. You're selling a project that is an investment property. And you're not going to get taxed on those funds, on any other earnings, the equity you've received from that sale, because you're going to move all that money into a like-in-kind property. You have so much time to actually designate what that property is, but you can move that equity into something new. And it's a thing that the IRS put together because they wanted people to reinvest in real estate.
And you can trade up. Right?
Yes,
okay,
exactly.
so we're going to come back after the break, but essentially that means swap till you drop, keep trading up for your life and don't
right.
sell. When we come back, we're going to wrap this discussion up and talk about some final thoughts on this and look at how project structure may be changed based on debt versus equity. I'm Steve Matley, your host for Real Men of Real Estate. Don't go anywhere.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
Welcome back to Real Men of Real Estate. I'm your host, Steve Matley. Today, I'm with Brian Fox and Tunde Ogunwole, and we've been talking about where's the money for these real estate projects. Gentlemen, we have just a few minutes left, and I want to kind of get into how it may affect our projects depending on the type of money we use. So I'm going to start with you, Tunde, over here, because you work on commercial projects. The structure of the project itself is going to change. It's not just as simple as buy a piece of property, fix it, and build it and sell it. There's actually a whole business structure that happens based on how we get the money. So talk about that.
There are multiple phases to a development project. Obviously, land acquisition is the beginning, some feasibility, due diligence. Then you get into design and construction, permitting, the marketing and leasing, and then the closeout. On the construction component, if you're looking at that example that I gave before, that $100 million project, 40% is a construction loan, 40% or $40 million is a construction loan, 60% on the equity. The way that we're approaching that project as a private enterprise, it's a pretty aggressive, multi-phase at the same time. A lot of activities are happening to reduce the timeline of getting the development project done. It's pretty aggressive. The outside dates of when you need to complete to be able to monetize are something that's closely scrutinized. In comparison, if we were to do a public-private partnership where bond financing is being used and the developer isn't necessarily putting up the same level of risk and personal guarantees, it's the backing and the professionalism that's being brought to the table, the development expertise, and they're being paid a fee. The complete structure and the way the level of interaction and the durations are different, and I think they benefit a project in a way. It gives you a little bit more time to explore many different ideas, take in public comments in a different way, and introduce that into development and complete it at a different timeline. So that definitely changes the dynamic.
And you brought up bonds, and bonds are in fact debt funding of a project, but it's where the taxpayers went to the voting booth and said, we use our collective credit card to fund the project.
Exactly.
Right, okay. So Brian, on your side, you do these, say you're doing a fix and flip kind of deal.
Yeah.
Will that look different depending upon whether we're using an equity funded project or a debt funded project?
You know what? Absolutely. This flipping phenomenon, is what I'm going to call it, has gotten so saturated that the deal will come down to dollars and cents. If you have to make so much to even make it worth your time. And there's a lot of people who are willing just to get into a project just for the fun of doing it at this point. A lot of them will lose money. So the reality is, if you're going in with debt, if you have a lot of fee structure attached to the loan you're going to receive, it could kill the deal right there. I mean, you might have a $100,000 deal that you could collectively make $100,000, but then after points, fees, 5 months of carry, and you're talking about, depending on what the project is, if you have to add square footage, if you do stuff that's going to take a lot longer time, and it's not just a turn and burn deal where you can get it done in 3 months, you could see yourself bleeding through the equity you're trying to earn. And we've seen that. So we had a deal in the desert we were doing, and we totally underestimated what was going to happen with the construction people in the area that we were trying to work in. It was a good deal. And we did make it out okay, but the reality was we totally underestimated that we don't know the population. And if you're trying to find good people to do the work out there, and they're not someplace that you can get to quickly, and you do not know what that's like and don't have a team, it's a variable. And so depending on how much cushion you have in this deal, you might just not account for the variables, and this extra debt coverage will absolutely crush you.
And that's a great point that Brian's bringing up, that carry cost, that relationship between how quickly are you getting the return on your equity and how does that influence the bond obligation or the debt obligation. So if you're going a little bit longer than you originally expected and you have this double-digit interest rate, or I'm sorry, double-digit equity rate, return on equity, that relationship between the debt that needs to be satisfied and what people are expecting on the equity side is significant. And so anything that happens that delays those really does change the dynamics of how people approach their projects.
It's that time value of money issue.
Exactly.
So any of you that ever took basic finance, that's what that is, present value, future value, all that stuff. And the key on that is on the debt, the longer it goes, the more interest you pay, and the more that eats up the amount of money you have to work with and eats into your profit. On the ROIs, on the equity side, the longer you go, the shorter the ROI goes because we base on an annualized, and we can get the same profit in the twice as much time, and it's half the ROI.
Typically on the equity side, people are expecting a certain type of equity return. So that's also
right. It dilutes it.
It dilutes that return.
And so we can give them the same amount of money 12 months later, and they're not happy because the annualized return on investment went down, and that's not what they were expecting.
Exactly.
And so, 2 seconds on this, but the planning of this stuff, the preparation is so important. There was a deal we did. It's hilarious. We did a deal, and it was like unraveling the sweater. You couldn't get done with this thing, and it took forever. We would have made more money had we never done anything and just held it for a year and let it go. We would have made twice the money.
And now that goes into the feasibility side of it. And you mentioned feasibility as one of the first part of the projects. Before we do anything, before we decide on how much debt, how much equity,
right.
we have to say, do we even want to do this?
Right.
Sometimes the best decision is
to not
do it. Not do the deal.
The best decision is never no decision. The best decision could be don't do it. That's still, no is a good decision sometimes. Yeah. And you're right. Sometimes if we're going to lose money on a project, we'd have made more money, had more fun scooping ice cream during that time. No two ways about it. Well, that about wraps it up. I want to tell people at home, this is the first in a series on these. This was an overview, and we barely scratched the surface.
Right.
This is tip of the iceberg stuff. Over the next few months, we're going to be focusing on each of these little issues and getting in depth and even bringing some guests in to share with us. We've been talking about where's the money on Real Men of Real Estate. I'm Steve Matley, your host. Thank you, Brian Fox, Tunde Ogunwole. We're going to see you next time in Real Men of Real Estate. Bring a notepad because you're going to learn a lot.